Let's get to Bob Pisani. Hey, Bob.
Good morning, guys. Happy Wednesday. Important thing here is it's a flattish open. Carl's right, but supply chain issues are going on longer than anticipating, starting to weigh on the market. Take a look at the sectors here. Materials a bit on the weak side. Tech, which has been a market leader for a while, also slightly on the weak side. Consumer discretionary flattish. Banks have been moving sideways for months now and haven't been able to get much traction at all. So you see a flattish open. But beneath that, I would call this so far great numbers, strong demand everywhere, but kind of story. And but mostly is around labor and supply chain issues. So the big discussion today was around Sherwin-Williams and what they were talking about. And they did emphasize they've had terrific demand, strong demand, but raw material availability is not improving. So in the second quarter, their sales were impacted 3.5% negatively because of inability to get raw materials. In the third quarter, now they're saying sales are going to be impacted in the high single digit. This is going on longer than people anticipated. And we've seen this. We saw this yesterday with PPG. Same thing. What are they doing? They're adding a 4% price surcharge, but they made it very clear through the end of the year, they'll add more or keep going if they have to. In other words, right now they still have pricing power, so that's helping them out a little. And that's probably the reason the stock is only down about 3%. But nonetheless, the fact that all of a sudden now we're into the third quarter and possibly the fourth quarter with this going on is starting to become an issue. We've seen that out there. Same thing with the home builders. Great demand. We still see it out there. Pulte came out and emphasized we have strong demand, but look what they're talking about. They had lower closings than expected. Why? Well, it wasn't because the demand was lower. They had supply chain issues. They've had problems with getting materials. They've got labor shortages that are out there. So the home builders, they're down today, but if you watch them, they topped out in May. But still, their overall numbers have been very strong recently. So look what's going on. Underpinning the rally, we've had record earnings, we've had record margins, and we've had low interest rates and strong revenue growth. This supply chain problem eats away at the edges, not dramatically, but it starts to eat away at the edges of the margin story and the strong earnings growth story. And that's why the market's a little bit on edge. The reason we're holding up so well is what you're seeing right here. Technology continues to see earnings estimates go up. Why? Because technology wins if there's more COVID or loses, and wins if there's less COVID. That's what's going on, essentially. So today, 28% growth in third quarter earnings for technology. 2 months ago, 22%. That's a strong increase. This is the largest sector. It drags everyone up. Communication services also up. Healthcare, another generally associated with the growth category. Got a lot of biotech in there. Same situation. 14% growth today for the third quarter. It was essentially 7% going back to July 1st. Because you have, Carl, these incremental increases every week in the earnings estimates for the biggest sectors, the S&P continues to hold up very well. And, Carl, I have never seen so much interest in people trying to figure out whether earnings estimates are going up or going down on a week-by-week basis. Only me and 6 other people in the world used to ever watch this on a weekly basis. Now it's a part of the conversation every single day. Carl, back to you.
Fascinating. Thanks, Bob. Bob Pisani.
Shepard Smith here. Thanks for watching CNBC on YouTube.